In today's video, we're going to be focusing on this golden Bitcoin cheat sheet that's going to help you really understand where we end up finishing this Bitcoin market cycle. We'll be talking about the many interesting historical tendencies that we have seen recur in the past and have replicated also in this cycle. So let's dive into it. Subscribe to the channel for more videos like this in the future. Like this video if you enjoy content like this going forward. And before we dive into the video, a quick message from our sponsor. Our sponsor for today's video is BitUnix, and they are a really great crypto exchange for you to consider for your daily crypto trading and investing. They are a no KYC, no VPN futures exchange, and their liquidity is on par with the top exchanges. Users can trade over 700 trading pairs with up to 125x leverage without restriction. And to celebrate our partnership, we're running a very special offer. From September 2nd until October 2nd, you can sign up using my link and deposit $100 to get a 20% deposit rebate and get up to $2,000 trading bonus when you trade on BitUnix. Deposit reward will be distributed on every working day, and trading rewards will be distributed after the campaign ends. And for more info, check out the link in the description down below. So let's dive into the video and let's talk about the macro triangles, which I mentioned back in mid-2022. So eons ago, it seems like a very long time ago, but these are the patterns that continue to repeat. Downside acceleration into a key region, which has been historically identified by just looking at breakdowns from these descending triangles. We've seen downside deviations of 65%, 50%, and that gave me the range from which we reversed towards the upside into a bull market and beyond, right bang on in this range. And what's also interesting about what happened with this reversal from the bear market bottom, so these are all very useful concepts that will come into play and prove quite useful in this upcoming bear market. But before we dive into the bear market, we need to discuss the bull market ending. But these are the historical tendencies that we need to understand, because they also repeat and help us in identifying bull market tops as much as they identify bear market bottoms. Macro downtrend breaks, which occur around the 397-day mark. And if you think about confirming macro downtrends, then it did happen at the 397 mark right over here. So we broke the downtrend at the 366 mark. 397 mark, breaks the downtrend, and we reverse towards the upside. Here as well, we break the macro downtrend 396 days before the halving. Here as well, that history repeated. So we see a lot of history repeating overall in the cycles. And that's not just the macro downtrend breakouts, it's also the bear market bottoms, where around 500 days prior to the halving is where we see these bear markets develop. And obviously, what we've seen in the past, around the 500-day mark, plus minus a month or so, we saw copy pasting from 2021 right over here. 2021, or at least 2018, macro bear market bottom happened 517 days before the halving. Same thing here, where we bear market bottom 517 days after the halving in this market cycle right over here. And we also, at the same time, if we cycle back to this chart, broke the macro downtrend around a year before the halving. So these are all useful concepts that will come into play in the future market cycle, but they also come into play in understanding where could we bull market top. And so this is a golden cheat sheet that's not only going to prove useful in identifying the bull market top, but also the future bear market. And we'll be making another video on that in the future, so subscribe to the channel if you'd like to see that one as well. But let's talk about the bull market. Generally, mirror images of the pre-halving bear market bottom to the bull market top. You can see here that we hit the bull market top 518 days after the halving, but just showcases that 500 days before the halving, 500 days after the halving, that typically is a bear market bottom or a bull market top. 550 days before the halving here is where we bear market bottomed, and then 550 days here is where we bull market topped. So what we've been seeing generally is if we get 550 days before the halving for a bear market bottom, it takes 518 days after the halving for a bull market top. And if you see the flip side of that, 518 days before the halving for a bear market bottom, then we get 550 days after the halving for a bull market top. So if we're thinking about these tendencies, then history suggests that there should be 550 days after the halving, right? Because if we saw 2020 right over here and this market cycle overall have that bear market bottom take place 518 days before the halving, and the same thing happened in this market cycle, so maybe we should see 550 days after the halving for a bull market top in this cycle as well, which gets us into mid-October. Currently we're around 518 days after the halving, so by standards of history, by standards of 2017 history, we should be peaking, or should have probably peaked a few days ago. But as you know, August is where that local top took place, so it would have never been 518 days peak, but probably before 580 days, so 400 and something, which would imply an accelerated cycle, whereas many people are talking about lengthened cycles. And in fact, we are seeing more evidence for lengthened cycles more than accelerated cycles. Here, we saw a bull market top take place 518 days after the halving. The next cycle after that, it took 30 days extra. And in this cycle, maybe it does take 30 days extra. And if it does, that gets us into mid-November 2025 at 580 days after the halving. So if we are indeed seeing an inclining tendency, a progressive inclining tendency across the cycles, with these bull market peaks taking a little bit longer to develop in the post-halving period, then maybe indeed lengthening cycles, but to a very, very small extent, by 30 days each time or so. And if for whatever reason we get not just 30 days, but we add on 2 months, so double that amount, even if we're seeing some sort of doubling, that gets us into 600 days, roughly speaking. So end of the year, mid-December, roughly speaking. But 600 days is already a really large amount of acceleration, or at least lengthening and extension. And so adding 2 months already quite significant of a lengthening in of itself by standards of what we've already seen in the traditional halving cycles. So when people talk about even more of a lengthening into deep 2026 bear market territory, that's already a little bit too much. And so 2 months extension is already, in my opinion, too much, and 30 days would be completely natural. So it does look like we'll probably be peaking in the next, whether it's minimum at least month or 2 months, maximum 3 months. So it does give us a bit of leeway into Q4 of this year effectively. And historically, 2021, we saw early November peak, so bang on in Q4. December in 2017, really deep into Q4. So Q4 tends to be generally a really strong period for Bitcoin momentum, as we can see here, generally speaking. So Q4 is going to be the decider in this cycle. And we need to talk about diminishing returns in the same breath, because if we're talking about old all-time highs being eclipsed and then seeing this sort of parabolic price action to new all-time highs and beyond, and in this cycle we see old all-time highs get broken, and then we see this parabolic phase take place to this extent. And the same thing here, old all-time highs getting broken around here, and we see this amount of price action take place. You can already very clearly see that, well, there is diminishing return. That's just part and parcel of maturation in the cycle, and we can't really escape that. But with that acknowledgement, we can try and make the most of it, whatever limited upside we still have left. And these orange cycles, or at least orange circles in this cycle, kind of just pinpoint to us, where are we in the analogous candle of the previous cycle? So if we've peaked 550 days after the halving, and we're 518 days after the halving, roughly speaking, so we're currently here, and that means by standards of 2021, we're in this candle, so probably the last candle before peaking by standards of 2021, whereas by standards of 2017, we're already in this peaking candle here. So this orange circle just shows to us that 2017 is saying that we've peaked because this is when we peaked in 2017. 2021 says we have a month left to peak, and if we do indeed get that additional month, I think we will get that additional month, because by the looks of it at the moment, it looks like we've topped out a month ago or so, which would insinuate an accelerated cycle, and so I still feel like we do have new all-time highs ahead. So minimum we top out mid-October, and if it's lengthening, then mid-November, and if we do really get extended periods of price action towards the upside, then December. But I feel like we shouldn't be moving the goalposts constantly, because that's how also you round trip your gains. And we're not interested in round tripping that. We are only interested in exiting in a strong uptrend, because exiting the positions when we're suddenly in a bear market, it's going to be it's a difficult position to be in. So better to be selling into strength rather than selling into weakness. Better to be selling into strength rather than into weakness, and same thing here. So the bull market slowly tapering off, but as we see, generally bull markets tend to last, roughly speaking, 1,000 days or so, plus minus 18 days, 30 days to either side. So generally it's 1,066 days that we see these bull markets take place over the course of history. And if they are extending a little bit, then maybe that gets us from 1,066 into 1,100 days or so. And so at the same time then, to understand a bear market bottom, 500 days, roughly speaking, before the halving, and 500 days after the halving is when a bull market peak occurs. And cycles last 1,050 days, 1,000 days or so. So these are really great insights that will help even 4 years from now. If you just watch this video and all you do is watch this video and remember these principles, 4 years from now you'll be able to do really well in the bull market. 2 years from now or a year from now, whenever the bear market bottoms, you'll also be able to identify when that key moment occurs. But last thing about bull market targets, if we're looking at this parabolic upside, and this is the midpoint of that parabolic upside, and then we compare that to here, just notice how we've cut that 2017 parabolic upside from old all-time highs. We've cut that in half, more than in half. So if we're talking about this being then the midpoint, and we do something like this, then this midpoint here is very, very close to where the price action is at this point in time, which then kind of means that we have maybe a little bit extra upside. We're very close to that top if we're just following those tendencies. So if you think about this much upside then potentially being left, and we have a bear market like this left, that just gives you idea that the risk of upside, or at least the prospect of upside, is, let's say, this much, and the risk of downside is, let's even try and be a bit conservative here in terms of that downside. It would be that much. So risk of upside, or at least prospect for upside, risk of downside. And we'll be talking about this in future videos, so of course subscribe to the channel for more of them. But in terms of bear markets, we've seen old all-time highs really act as a key level. And in the past, we never really got into those old all-time highs. But now old all-time highs have been deviated below. So if these are the old all-time highs here, then deviations below those old all-time highs are gonna not be just shallow like they were back here, but they'll probably be a little bit deeper. So if we're thinking about a bear market, and notice also bear markets are getting a little bit shallower as time goes on, right? Notice this is 84.5%, I believe. Here we get 77%. So just notice that it's already a shallower. So diminishing upside, diminishing reward in these cycles, but also diminishing bear markets as well. So we're not going to get this sort of bear market. Maybe we see something a little bit shallower, and deviating below old all-time highs probably on the cards, but by a vaster margin, not just this small deviation, but maybe we get a deviation like that overall. And so that's how we can roughly calculate that bear market bottoming out region. But obviously we don't have all the data points because we don't know exactly where we've peaked. And if we do peak a little bit higher, then obviously that downside deviation, factoring that downside deviation in and factoring in the bear market retracement, these are all things we're going to be talking about in future videos. So obviously if you want to see more videos like this in the future, comment below, like this video for more videos like this in the future, subscribe to the channel, of course, to keep abreast of everything when it comes to bull markets and bear markets going forward. Thanks so much for tuning into this video, and I'll speak to you in the next one. Speak to you soon.